Well, welcome back. Stocks are higher this morning as we are looking ahead to the August Consumer Price Index. It's out tomorrow. Dow Industrials right now up 119 as the momentum from last week continues. Economists are expecting a month-over-month decrease in the CPI of 0.1%, a year-over-year increase of 8.1%, which would be better than the 8.5% we saw in the month of July. Joining me right now is Federated Hermes Senior Portfolio Manager and Equity Strategist Steve Chiavarone. Steve, great to see you. Thanks so much. How important are you viewing the CPI report for investing this week?
Well, I think it's important, but I think the headline number is less important. It's going to come down with the way energy prices have acted, or at least oil prices have acted in the last month. But the bigger story here, and where we're going to be focused, is on the core reading, which is actually expected to move higher from about 5.9 to 6.1%. That has the elements of inflation that are sticky, the ones that the Fed is going to have a hard time bringing down. Things like wage inflation, things like home price inflation, which is still, moving higher, and we think will come down later, but not quite yet. And that's the part that we think keeps the Fed very much on track for a big rate hike in September. In 2 weeks, we think it's probably going to be 75 basis points. So important report, but it's not the headline coming down that's the story. It's the core that continues to go higher.
Well, it's interesting. We had Kathy Wood on from ARK Invest on Friday, and she is predicting this huge decline in inflation. She's looking at the PCE indicator, just as you mentioned. And she says it's going to go into the threes over the coming 6 months. What do you make of that?
Yeah, look, you got to ask yourself why, if that occurs. So number one, I think it's too early to make that call. Yeah, it's too early to make that call because we don't know what's going to happen, as one of the guests mentioned earlier, with energy prices in Europe over the course of the winter, particularly with the Russians, having a very difficult weekend. That's not going to probably make them inclined to want to turn the gas on very quickly. Wage pressures are still moving higher. And if inflation does roll over hard, if that's occurring because we're entering a recession, which is looking increasingly likely, that's not positive for equity markets. That's not positive for risk assets. So we think inflation will roll over. The Fed's hiking. They're hiking hard. But if it comes off because we're headed into recession, that's not a positive outcome for it.
Yeah, it's a great point that you make, and I think nowhere is that more evident than in the oil markets. One of the reasons that oil has come down as much as it is because of a slowing economy. Take a look at where we stand this morning, both Brent and crude below $100 a barrel, but still showing a gain this morning of about 1%. Janet Yellen is saying that we are likely going to see oil prices go back up in the fall. So even though we are looking at a better situation when it comes to energy, the catalyst here is a potential recession, slowing economy. What does that mean for earnings and the stock market?
Well, yeah, and this is one of the reasons why, at Federated Hermes, we're traditionally a bullish shop, but we find ourselves underweight equities, for the first time in quite some time. And it's because we think there is a risk to earnings. Notwithstanding the two-day reprieve in the dollar represents a risk to earnings. Our outlook for the economy and the potential for recession represents a risk to earnings. And to your point, what we're seeing in not just oil, but the broad commodities complex is, commodities that are very worried about demand in the U.S. and China as they continue to pursue COVID zero. So again, if these prices were coming down because supply was improving, that'd be great. If they're coming down because demand is projected to collapse, that's worrisome for not only the economy, but certainly for corporate earnings.
So, it's interesting that you are looking at these high cash levels at Federated in the face of all of this. Is there anywhere to hide in this market right now?
Yeah, so we're at 10% cash in our asset allocation models, which are, it's as high as we go. We'd love to deploy that into bonds at some point, but right now we think the market is still kind of grasping and dealing with having to price in higher rates. We think that the federal funds rate has to go at least to 4. And so for that period of time, we're content to stay in cash. And then on the equity side, we want the most defensive names. We want defensive dividend payers, consumer staples, utilities, healthcare. We want a portfolio of stuff that you need to buy, not stuff that you want to buy, because we think we're going to have a very difficult economic environment ahead.
Steve, what do you make of these Twitter headlines? We're just getting headlines crossing the tape. Twitter is responding to a third notice of termination from Elon Musk. This third notice it received on September 9th. Twitter says it will continue to pursue its right to specifically enforce all of the Musk party's obligations under the agreement. Twitter says it intends to enforce the agreement, close a transaction on price and terms agreed upon with Musk parties in response to third notice of termination. Musk says they've breached none of the representations or obligations under the agreement. The stock right now is down about 1%. Any thoughts on where this is going?
I mean, I'm not an expert on the specifics here. I think it is interesting, though, when you have a scenario where please don't buy us, and now you better buy us. I mean, that's certainly the environment over there. Look, I think in general, I'd be a little bit nervous about buying a tech company right now as well. Valuations are likely to come down as interest rates go higher. Earnings are at risk. We prefer certainly the value parts of the market. So if I'd be Musk, I'd be looking to get out. And if I was Twitter, I'd probably look at be keeping him in. So it's certainly going to be some entertaining drama for the days and weeks to come.
Yeah, you're right, Steve. That's so funny because for so long they were saying, don't buy us. We don't want this. And now they're trying to keep him at his word. And he's saying that so many accounts are fake and he's not going to go forward. He doesn't believe what they're telling them in terms of the number of fake accounts. Steve, it is great to see you this morning. Thanks very much. We'll be watching that broader market.
Take care, Maria.